Hello, this is Jordan. This video is being recorded on the late afternoon of Monday, August 29th, 2022. Thank you so much for joining me today. Please like, comment, and subscribe if you find value in this video. Thank you. In this video, I am going to talk about the bear market template, at least for bear markets within secular bear markets. So we're looking at cyclical bears within secular bears, and there have been 3 secular bears dating back over the last 100 years, and that's really the question. I mean, it has been for the last couple months. It will be over the coming months. Are we in a new secular bear market? And I think we're going to find that out by the end of the year. And so if we're looking at this template and we're looking at, there were 2 nasty cyclical bears in the 3 secular bears. So you have a total of 6. Again, going back over the last 100 years and looking at those bear markets, you had around a 20% on average, 20% or 25%, something like that drop to begin the bear. And then all of these 6 bear markets, they rallied back to the 200-day moving average. Some went a little bit below, some failed right at the 200-day. And if we look at the average of when that happened, the median and the average of those 6 were around 7.5 months in. And if we look at what happened in the last couple weeks, the S&P touched the 200-day moving average exactly 7.5 months into this bear market, if this is a bear market, if it's going to continue. So, and you can see here, I'm just showing, not going back to the 30s in that secular bear, but we can see here the 4 bears, the 4 major cyclical bears during the last 2 secular bears. And I think there's quite a few similarities to what happened in 1968. But whether we're looking at that or 2000, 73 to 74, 2007 to 2009, you can see the blue arrows, and even late 70s and early 80s, you can throw those in there. When you're going into a recession and you think you're going to have a real bear market, when the market rallies up to the 200-day, I mean, that's really a sell signal, especially when it does it early on in the bear. So we may have just had a very significant sell signal a couple weeks ago. If I want to be more bullish and look at the bullish outcome, maybe we see something like we saw in 1962. Look at the bottom left of the chart. The market declined. I think it was about a 28% decline. The market even fell below the 40-month moving average by more than a little bit. Then it rallied a little bit, came back, and kind of made a double bottom. Then it kept rising consistently into the 1966 peak. So I know some more of the perma-bull types are throwing that around. So there's a lot of similarity to the mid to late 1960s, in my opinion. So if you want to say that the secular bull is intact and we're going to continue to climb, the 1962, that analog is one that you really have to believe in. And I'll just note, from the 1962 peak to the 1968 high, the S&P only gained 50%. So, yes, you had major blow-offs in the 1920s and 1990s, but in the 1960s, you didn't have that. Again, from 1962 to 1968, when inflation was picking up, the market only went up 50%, and it was still in a secular bull by most accounts. So it wasn't that great of a secular bull, but I'm babbling on. But so that's really the bullish, that's really the historical link to look at if you want to make a bullish case. But when we look at really the template for what happens in these cyclical bears within a secular bull, you have the 20-25% drop, and you rally back to the 200-day moving average. It fails. So what has happened so far that is more in line with the nasty bear markets, those nasty 6, than what happened in 1962. It's just looking different at this point. And so here are some hard data, and I added in the data there on the right, what happened afterwards. So the first column and again, these are the 6 nasty bears, the 6 cyclical bears that were within secular bears. I think the median the median time average of those 6 was around 7.5 months. The average 7.2 months. So the S&P, it was 7.5 months. It touched the 200-day at 43.25. Look what happened after those other bears tested the 200-day for the first time. Those are some real nasty declines. So there has been pain already with the 25% decline, a lot of pain in tech stocks, gold stocks definitely. But look what happened afterwards. So when you're in a nasty bear market, the first rally up to the 200-day, that is, it's impossible to sell the top, but that's really the point where the smart money really gets out. And so, I mean, we could look what happened in 1968, a 31% decline from the 200-day. So, I mean, a 30% decline puts the S&P at around 3,000. I mean, the low was at the low in June was at 3,600. So far we have not seen earnings decline that much. It's mostly been a valuation decline, but we're looking at the indicators that they're signaling we're likely to have a real recession. So I do think that the probability favors the S&P making a lower low and losing the 40-month moving average. And going back here, the vertical line there that you see 1970 around 2001, 2000, late 2008. The vertical line shows the major lows in precious metals. Now, at the beginning of 70, I think it was the very end of 69, that's the gold stocks because the gold price was fixed. But, end of 69, that happened as the S&P was testing the 200-day. You look at what happened at the beginning of 2001, and then also what happened in October of 2008. So, I mean, the bottom did happen towards the end of that real crash. But that gives you some perspective of what this means for precious metals. And so I continue to strongly believe that if we see the stock market, if this is the start of another leg lower and it's going to make lower lows, at some point during that decline, you're going to see precious metals bottom out and start a real move higher. And that could be the start of a real secular bear market. So potentially a really exciting time coming up, not just in the next month or two, but over the next 3, 6, 9 months. I'll continue to monitor this bear market template and see how things develop. But so far, it looks to be on point, signaling that we're headed for a very significant bear market and that there will be a recession. Let me know what you think in the comments. Thank you very much, and I'll see you again in the next video.